It's Wednesday afternoon in Singapore. Tuesday, yesterday in the US, earnings season kicked off. You had JP Morgan, you had Citibank, you had Wells Fargo, you had Bank of New York, you had a bunch of banks report pretty good results for the second quarter of this year. The reaction of their shares was mixed. That sort of fits in with what I was saying last week. U.S. stock valuations are elevated, and earnings results are coming out, and they were got to be good, but they probably wouldn't be good enough to really drive shares higher. If you remember, first quarter, in the first quarter, we heard fourth quarter 2024 earnings results, and they were double digit. 3 months ago, we got the first quarter earnings growth. That was double digits. And looking at what we'll have for the second quarter, that seems more likely to be in the range of like 6 to 8% earnings growth. Good growth, but not the kind of fantastic thing that's got to really spur a rally in the stock market. Now, last week, I kind of gave my theory on what would make stocks go higher, and that was lower interest rates. And of course, last night in the US, we had an important piece of inflation data come out, the June CPI number. Economists were saying that that number was going to be the first one that really reflects the impact on inflation from Trump's tariffs. And sure enough, the June data showed a tick up of inflation from May. The tick up was largely in line with what the economists expected. So there wasn't an immediate market reaction. But at the end of the day, that was kind of disappointing for the markets because they were hoping that something would be in there that basically gave some impetus for the Fed to maybe cut interest rates a bit sooner than the September rate cut, which is generally expected. And in actual fact, what happened after that number is that the 10-year Treasury yield actually went up. So it was generally a disappointing market. And as if you looked at the market yesterday, it did finish lower. I started off by saying earnings season kicked off with a bunch of big banks, but that's a new thing. Traditionally, the kickoff of earnings season, or the unofficial kickoff, was by Alcoa, the aluminum company. Well, Alcoa is actually reporting today, Wednesday, after the close in the US, but on Tuesday, its share was down about 4%. And also the whole materials sector in the US, the other companies that make cement or chemical companies, et cetera, Albemarle, the company lithium miner, all those shares were weak yesterday. And the reason given was higher interest rates. So basically that also confirms, that one's not a big surprise, but it confirms what I was saying is this is a market that very much wants to see interest rates going down and to see a higher 10-year yesterday and what impact that might have in the housing market and building activity in the US. Well, that was negative for the market. I just want to point out a couple of detail things about yesterday's CPI that I thought was interesting. The first thing, electricity prices were up month on month 0.9%. That's like 4 months in a row of 1%, 0.9% increases. Obviously, that has nothing to do with tariffs. The U.S. doesn't really import electricity, but what it does mean is, but what it is a reaction to is the big build out in data centers and all the increased demand in electricity. So that's got to be a backdrop in US inflation for many months in the future because that build out of data centers is not going to end. Also in the numbers, people point out that although there's plenty of anecdotal evidence that US house prices are dropping and US rents are dropping, in the official data, it still showed shelter as being part of the inflation picture in the US. And finally, the last thing to point out is even though Trump has put tariffs against imported cars, you saw used cars and I think new cars as well drop in price. So you can't assume just because tariffs go against a product that you're going to immediately see prices going up. Now, to go on to tonight's action, we have Bank of America reporting. Bank of America was down after the other banks reported yesterday, and that's probably due to the fact that JP Morgan had although its results were generally good, its comments about its net interest income were sort of a negative. And also with Wells Fargo, they missed on net interest income, and they also said their net interest income growth this year would be lower than they previously expected. That's why Wells Fargo share was down yesterday, and that probably seeped into Bank of America's price. So when Bank of America reports later today, people will be looking very closely at its net interest income. Also reporting before the market opens today on Wednesday in the U.S. will be Johnson & Johnson. Johnson & Johnson has been dead money for investors. I think for the last 5 years, the stock is barely up. Yet it's a company that's going through some strategic changes. The most important change is the company is trying to balance itself between being a drug company and a medical device company. And so they've been trying to grow their medical device business. A couple of years ago, I think it was about 2.5 years ago, they bought over the heart pump maker, Abiomed. That was a very expensive acquisition. And when the results come out, once again, people will be very focused to see how well their medical device business is going. The other strategic decision that Johnson & Johnson made was to get out of their over-the-counter drug business. Now, that's actually a pretty good business. Those are companies like Panadol and Band-Aid, and that was spun out into a listed company called Kenvue, which similarly has not done too well. And why I'm touching on it, although Kenvue is not reporting earnings today or yesterday, Kenvue yesterday got rid of their CEO. And the explanation was that he wasn't doing a good enough job of making Kenvue an attractive target for acquisition. And interestingly enough, Kenvue had hired a new CFO recently, and that person came from Kelowna, which it was one of the two companies that resulted from the breakup of Kellogg's. Kelowna was its snack business. That got when Kellogg's got broken up, the snack business got taken over, and of course at a premium. And actually, just a few weeks ago, the remaining cereal business got taken over by the Italian chocolate company Ferrero Rocher. So Ferrero Rocher, which also owns Nutella. They'll be able to make their own Nutella cereal now, but it does show that often breaking up those companies reveal a bit of value. So you might speculate that Kenvue, which is a much harder target to take over because it trades at a pretty high PE and it's a $30 billion company, but sort of its weak brands has been its skincare brands, its Neutrogena, its Aveeno. Maybe they will try to spin those out so the better brands are separate by themselves and become more of a target. I don't know, but I just thought this was sort of an interesting story related to Johnson & Johnson. Anyhow, that takes care of my points for this week. I'll talk to you again next week.